Yo guys, welcome to the new video. Hope you are doing good. In this video, I will discuss about the most important topic about the multi-time frame liquidity analysis. Because you have heard about the multi-time frame structure analysis right in the past, but it was completely fake. The structure is completely fake. It is the biggest distraction ever. Structure is the biggest distraction. You can't see the real thing if you use the structure in the market. That's why 99.9% people are unprofitable in the markets. If you just do the opposite what 99.9% blah 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 people are doing, you will be insanely profitable in the market. So I will explain how the multi-time frame liquidity analysis works. So normal smart money people will mark the structure like this. Break up the structure, break up the structure, and they will use the order blocks, right? They will have numerous order blocks, number of order blocks, right? So they don't even know which order block they will use. They don't even know which order block they will use because they will use the order block in between here and they will call it as the decisional order block. They have number of order blocks. They will take loss here, loss here, loss here. There is no guarantee for the smart money and retail people in this game to make money if they don't have an edge. But with my strategy, we can exactly know at which order block the market is going to reverse because the market obeys some sort of specific pattern when the market is going to reverse. But the market, when it wanna go continue down, it will not form that pattern. It will just go continue down. But if it want to continue to the upside, it will form one specific type of price action which I mastered in the past 5 years. So I will exactly tell you in this video how to understand the multi-time frame analysis of the liquidity and combine with the 1 minute time frame. So let's go deep dive into the video. So this is how the structure works at higher highs, higher lows, higher high, higher low, higher high, higher low, higher high, higher low. So let's assume this is the daily time frame. The black one is the daily time frame. So now this blue one is 4 hour time frame. The 4 hour time frame structure will be like this, right? This is how the oscillation of the structure they teach, but this was completely fake. I will tell you why this was completely fake. The books will tell you like the structure will be simply like this: higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. This is like structure will be there. They will teach this false language of the price action, but this is completely fake. This is completely fake. The real structure looks somewhat like this. The real structure somewhat looks like the stop points, always stop points before going into the real direction. This is completely fake. You don't see this type of clean structure anywhere in the market. This is why, because of this false education given by the retail brokers and investment banks, 99.9% are unprofitable in these markets. So, if you wanna be profitable in the marketplace, you should know the liquidity concepts where the stop losses will be. This is the liquidity. This is the liquidity. This is the liquidity. So if you watch this video till the end, I will exactly explain how the market moves from the structural standpoint to the structural standpoint. So we are using this fake structure for the liquidity to the identification of the liquidity because we should know the way the retail people and smart money people will buy the market so that we can sell the market there and do the vice versa. So we should know where exactly the retail sheeps and smart money sheeps are getting in the trade. So we should wait for them to get taken out and then enter the trade. So these two are completely nonsense education. So I will explain the real structure how it looks like in the minor time frame. So let's say this was the daily time frame. This was the daily time frame. Now I will draw the 4 hour time frame. This is the 4-hour time frame. If you see, in this small minor structure also, there are lot of stop hunts will be there. There are lot of stop hunts to continue the trend. Can you see? Lot of stop hunts. Because when the price wanna go in the one direction, the price behavior will be like this. This is the price behavior versus the price delivery. Can you see? This was the price behavior. Stop hunt again, and the price will continue. Again, it will stop hunt, it will continue. This is what the 4-hour looks like that. See, if you clearly observe from the standpoint, the black is the daily liquidity, or if you assume the black is the 15-minute liquidity, this liquidity is 1-minute liquidity. Very important. This is how the real market moves. It will stop hunt and it will go in the real direction. It will stop hunt, it will go into the real direction. It's a very important vast concept you should cover. So I will give you the time frames which you should look on. It is very important. Daily and 4-hour and 1 hour and 15-minute or 5-minute. 15 minutes and 1 minute. So if you assume the black as the daily liquidity, the blue is the 4-hour liquidity. If you assume the 1 hour as the daily liquidity, the blue is the 15-minute and 5-minute liquidity. If you assume the black as the 15-minute liquidity, the 1-minute structure will look like this liquidity standpoint. So in context, if the price wanna move in one direction, the price behavior will be always like this. At any time frame, if you look at daily, weekly, 1 minute, 1 second time frame, the market will stop hunt, it will go up, it will stop hunt, it will go up, because it needs liquidity. The market needs liquidity in order to move the price. That's why the stop hunts happen in the marketplace. That's why the stop hunts happens in the marketplace. This is the very important concept which many retail people don't understand. Because why, I will tell you now. So you should take consider of the minor details here in the strategy. Let's say this is how retail people will trade. They will think it as a break of the structure. They will think it as a break of the structure, and they will have the buy limit here. They will think the resistance becomes support, and they will buy here. Their stop loss will be hit, and then the price moves. Again, they will buy here. Their stop losses will be hit. They will go up. If you see here in this scenario, how many times the retail people are getting trapped, because the liquidity is taking up. Here the liquidity is taken out, liquidity is taken out, liquidity is taken out. If this much times the liquidity is taken out, the market got liquidity to get the price reversed, right? So that's why the pullback will happen. The pullback will happen. Again the price continues the uptrend by taking the liquidities. Again, after taking the liquidities, again the price should reverse, right? This is how the price moves from the liquidity standpoint to the liquidity standpoint. That's why the reversals and retracements and everything inducements occur in the market, just because to facilitate the orders in the marketplace. This is the very simple concept if you understand very clearly. So you understand, right, how the market moves from the liquidity standpoint to the liquidity standpoint. So that I will explain multi-time frame structural liquidity analysis. First thing is you should identify the daily time frame in the marketplace. To identify the daily bias of the day, you should identify the daily liquidities. Let's say this is the daily trend. Let's say this is the daily trend, and this was the daily liquidity. Let's say this was the daily liquidity. We'll use the blue color for the daily liquidity. So last liquidity level that was taken is the sell side liquidity. So we should focus on only the sells, because here the liquidity is taken out, right? The liquidity is telling to sell the market. Until when? Until this liquidity point. We should continuously focus on the sells in the intraday. In the intraday wise, the sells are high probable than the buys, because what the higher time frame liquidity is telling? The higher time frame liquidity is telling sells, 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 because higher time frame is always greater power than the lower time frame. So that's why we should always trust the higher time frame. Now, in the lower time frame, where we enter the market, for example, let's say this is how the market moves. So if you will get it out where we should enter into in the lower time frame, right? I will exactly tell you where to enter in the lower time frame. So this green is the 5-minute structure. Let's say this is the lower time frame entry. So if you see here, the 5-minute structure in this leg will look like this. We will enter at the liquidity sweeps. Where is the liquidity sweep? This is one liquidity sweep. We will enter the sell position here, and this is one liquidity sweep. We will enter the sell position here, because why? These liquidities are aligning with the daily liquidities. That's why there is a reason to sell, because we have done the multi-time frame liquidity analysis. So the first thing we should do is we should always check the daily liquidity. What's the daily liquidity is telling us? What's the last recent daily liquidity sweep? So the last recent daily liquidity sweep is this liquidity is taken. If the upside liquidity is taken out, we should focus on the sells. So if the downside liquidity is taken out, we should focus on the buys. That's it. Very, very simple strategy. Nothing complex. This is how we understand the liquidity analysis in the marketplace, and then we make sure we get a solid daily bias for the intraday moves. So we should not focus on buys in these levels, because the daily liquidity is tell like the buys are not high probable. The sells are very, very high probable. We can get 80 to 90% win rate in the sells because of the daily liquidity. So this is the simply what I am explaining the concept multi-time frame liquidity analysis. This is the very, very important concept, because I told you the market moves like this. It's complete bullshit, guys. It's complete scam. Complete scam. If the market moves like this, everybody will be a billionaire, right? If the market moves like this, everybody will be a billionaire, because if the market respected these type of order blocks like this, like this, like this, like this, like this, it will be here. Everybody will buy here. Everybody will buy here. We should use common sense. Everybody will buy here. Everybody will buy here. If everybody is buying here, where's the liquidity? Where's the liquidity for the market maker to provide for the buyers? Because for everybody to buy, there should be a seller, right? For everybody to buy, there should be a seller. So if there are X amount of people buying here, and the market maker don't have liquidity to facilitate this buyers, the market makers exactly know where the stop losses of the buyers will where the money is. So the market makers simply take the money, because at the stop losses means sell orders, right? Stop losses means sell orders. Now the market makers got the liquidity to project the price towards the upwards, towards this direction. So this is why stop hunts are common in the marketplace. This is the main reason. I hope you understand the main reason behind the stop hunts. This type of knowledge you can't find anywhere in the internet. These type of knowledge you can't find anywhere in the internet. If you wanna learn this stuff and my strategy, my proven strategy, you can earn 8 to 10% in a month consistently by using the liquidity analysis strategy. If you wanna learn my strategy deep dive, you can message me in the WhatsApp. My WhatsApp number is in the description and the comment section, and I will give the details about how to join the bootcamp. And I make sure it is not for the beginners, it is for the complete professionals who have experience in the smart money and the retail world for at least 2 years. Otherwise, it will be very, very tough to understand the concepts. See, I will again explain clearly. This is how normal people look the structure, right? Break up the structure, order block, break of 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 the structure, order block. Right? Many people will think the market moves like this, but it's completely scam. If you use the common sense, if this works, everybody will buy here, will buy here, will buy here, will buy here. If everybody is buying here, who is here to sell? Because if you wanna enter into the buy position, another people should sell, right? If you wanna enter the buy here, somebody should sell the market here. So that's why the market makers need sell orders to facilitate the buy orders. Simply, the market makers, because the market should be efficient always. So the market makers need sell orders in order to execute the buy orders. So the market makers intentionally take the liquidity. The market makers intentionally take the liquidity, and then move up, because now the market makers got the liquidity. If you see here, why I'm telling here the liquidity is many smart money people, millions of dollars of stop losses will be here. Millions of dollars of stop losses will be here in the marketplace. So after this millions of dollars of stop losses is taken out, now the banks have regained the efficiency of the liquidity. Now $1 million liquidity gain for the market maker. Now the market maker can distribute the liquidity because it got the liquidity. Now it can execute the buy orders. So the people who are executing the buy orders here can go with the market flow. They will be in profit. This is the simple logic about why the market maker is trapping you. Simple, just to regain the efficiency of the liquidities. So, and the main important thing is the brokers scams and the prop firm scams are very different. It's about the slippages and spreads. It is completely different. It's about the regaining efficiency of the liquidity gain. That's it. It's not a scam or nothing bad about the market makers. It's just a process to facilitate the liquidity for the marketplace. There is nothing wrong process about it. It is how the market moves. If there is no liquidity, the market will be stagnant. The prices won't move, because for every buyer there should be a seller, for every buyer there should be a seller, and for every seller there should be a buyer. Same thing for this type of market too. This is the fake structure. I am explaining about the fake structure. This is all the fake structure. If every order block is respecting like this, let's say, where the money for the bank to facilitate the sell orders, because if there are, let's say there are 1 billion sell orders here, 1 billion sell orders, 1 billion sell orders in your order block is very less, because the average daily transaction for the forex market is $5 trillion. So the $1 billion is very less. If you see here, this is $1 billion sell orders, and let's say the market maker don't have $1 billion buy orders to facilitate these sell orders. Let's say the market maker don't have $1 billion buy orders to facilitate these sell orders. So the market makers need the liquidity to facilitate the sell orders. So the market makers, where the liquidity of the market, the liquidity will be here, because majority of the people have short positions like this. They have stop losses here, and they will trade like this, small RRs. The stop losses will be like this. So here, if they want to execute the sell orders, the stop losses will be opposite of the sell orders. So there is 1 billion liquidity buying orders. There are a lot of buy orders is here. Stop losses are nothing but the opposite type of the orders. So the market maker take this liquidity and then move in the real direction. This is how the market moves in the liquidity standpoint, real structure never look like this. It's a scam. It's completely a scam. The real structure never looks like that. Never. The real structure somewhat looks like this. Always there will be a lot of liquidity grabs in the marketplace. The real structure, this is the real structure. Even if you look at the 1 minute time frame, 1 second time frame, 15-second time frame, 30-minute time frame, the time frame doesn't matter. Always, if you see at any time frame, the time is very fractal in nature. That this was the true nature of the price. This was the true price behavior. This was the true price behavior. If you see on the 1 minute chart, the price will be look like this. So if you see the same move on the 15-minute chart, the price will be like this, simple manner. And in the 15-minute chart, the price will be like this, same thing, liquidity oscillations. And in the small moves, there will be 1 minute fractals also doing this type of shit. If you see, same thing, the market will move like this, liquidity sweep, buy side liquidity taken, it will move down. So this is how the market moves from the liquidity standpoint to the liquidity standpoint, and you got a solid understanding about the time frame liquidity analysis. So if you want to join the private membership and the bootcamp for the October, I am running a 50% discount right now because it is the last day to join. So WhatsApp me, my number is in the comment section. Hope you like the video. Peace guys.